Okay, Black Dog Mortgage School. Talking about the APR today. And the APR is not the interest rate. So the annual percentage rate is something that the government came up with as a shopping tool to help the consumer not focus on the interest rate, but to focus on the cost of the loan. So the bigger the gap between the rate and the APR, theoretically, the more expensive your loan is. So if you see a really attractive interest rate, let's pretend like the interest rate is 3%, and if the APR is something like 3.7%, and you pay that loan over the entire term of, say, 30 years, your actual amount that you paid is 3.7%. And so the fact that you got to see the 3% is a little misleading, because the APR includes the costs that are not the interest. And the costs are only the costs that the government, when they came out with Regulation Z, which is many years ago, determined that those were the costs that were important. The reality is it's even worse than that. There are many costs that are not regulated by Regulation Z in the APR. So if your APR is a certain amount higher than your rate, it includes the ones that the government came up with, but it doesn't necessarily reveal all the costs. There could be even more costs. So as a general principle, if you want a good interest rate and you don't want to pay too much for it, then you want your APR to be very close to the interest rate. That means you're not paying too much. But real quick, the fees that they've identified are the daily interest, which is interesting because it totally depends on what day of the month you close as to what the daily interest is. But if you close on the first day of the month, you might pay a whole month's interest. And if you close on the last day of the month, you might pay 1 day's interest. And that also deems when your first payment is due. And then anything in the lender fees, which would be an origination fee, an administration fee, an application fee, an underwriting fee, a processing fee, points, or anything along those lines goes in that category, and that adds to the cost of your loan. Your loan might have mortgage insurance, so mortgage insurance adds to the cost of the loan, and that's actually paid monthly and sometimes as an upfront fee. So on an FHA loan, which has an upfront fee plus a monthly, you'll notice that the APR is almost always as much as a whole percent higher than the rate. And that's primarily because of the APR. And then a few miscellaneous fees that are small, that shouldn't have a big impact, but there's like tax certification, credit report, flood certification, county recording fees. And then finally, there are two types of loans that are very common, called VA and U.S. Rural Development, that have what's called a funding fee. And that's an APR fee, because you have to pay that fee to get the loan. So those fees total up, spread out over the life of the loan, and determined as similar to interest, make up the APR. So as a general principle, when shopping for a loan, if you're looking at 3 loans that all have the same interest rate, but the APR is not the same, then that means those different lenders are charging you different fees for the loan, and that's how you make a decision about which one's actually less expensive. Just one other small principle, the APR really is only accurate also if you actually hold the loan for the entire life of the loan, which no one does. But if you did, then it would be accurate. So an important principle is if you pay a high APR loan, it's actually worse, because most of those fees in the APR are upfront fees. And if you pay a loan off in year 5 by getting a new loan, then your APR was actually a lot higher than what you agreed to when you took the loan. It's only accurate if you actually run out the clock on the loan. So that's more of an incentive to try not to have an APR that's very much higher than your interest rate. So at Black Diamond Mortgage, we do low APR loans as a policy, unless the borrower really wants to see one of the other options, which we would gladly present. But if you just call in and say, hey, I want a mortgage, we're typically going to quote the loan out where the rate and the APR are less than 0.1 to 0.2 different, so that when you make that rate decision, you're pretty much getting what you bargained for, and you're not actually paying high fees. They're just buried in the loan and you never really see them again. So that's the quick view on APR and some of the contents listed on the blog page. And then if you work at Black Diamond Mortgage, you get the long version, which is coming up.